This is the luxury world. Get inspired with us today and tomorrow. The luxury watch industry is witnessing a profound realignment, and at the heart of this evolution lies Rolex, one of the most iconic names in horology. Once quietly traded among connoisseurs and insiders, Rolex watches have in recent years become the centerpiece of a global resale phenomenon known as flipping. This practice, where individuals purchase in-demand models and resell them almost immediately at inflated prices, turned into a highly profitable enterprise, blurring the line between enthusiast collecting and pure financial speculation. However, that era appears to be winding down. In this video brought to you by the Luxury World, we will delve into the reasons why the Rolex flipping phenomenon is losing its luster, drawing insights from industry trends and the perspectives of authorized dealers who are witnessing this evolution firsthand. If you have not subscribed to our channel yet, make sure to do so to stay informed on future updates. Today, Rolex is taking proactive and calculated steps to regain control of its market presence and redefine how its watches are bought, sold, and perceived. The company has begun implementing strategic measures aimed at discouraging short-term speculation and fostering long-term appreciation. This transformation is not happening in isolation. Rather, it is part of a broader shift in both consumer behavior and macroeconomic conditions, one that is gradually reshaping the very fabric of the luxury timepiece landscape. The practice of flipping initially gained momentum during a period of unprecedented global economic liquidity. As interest rates plummeted in response to the COVID-19 pandemic, disposable income increased, and many consumers, flush with cash, turned to luxury goods not just as lifestyle purchases, but as alternative investments. Rolex, already known for its meticulous production standards and tightly controlled supply chains, became a natural target. Speculators rushed to acquire steel sports models like the Submariner, GMT-Master II, and Daytona, pieces that, due to scarcity, could command double or even triple their retail price on the secondary market. This momentum was further accelerated by the rise of digital platforms and global resale channels. Online marketplaces allow flippers to market watches to international buyers in real time, often within hours of a purchase. Social media fueled the hype, presenting Rolex ownership not only as a status symbol, but as a smart investment strategy. Influencers, YouTubers, and watch traders showcased their gains, further enticing newcomers to participate. In effect, Rolex watches began functioning less like personal heirlooms and more like financial assets, fungible, tradable, and ripe for short-term profit. As the resale market grew more inflated and speculative, Rolex's brand identity began to feel increasingly misaligned with the direction of its product ecosystem. In response, the company began reasserting control over its distribution network. Boutiques and authorized dealers were given tighter guidelines, with stricter oversight on who qualified to purchase particular models. Buyers were often required to show identification, justify their purchase intent, or demonstrate an existing relationship with the dealer. The practice of allocating watches based on loyalty and purchase history became more deeply ingrained, reducing accessibility for one-time flippers and opportunists. Meanwhile, entering a Rolex boutique started to feel more like gaining entry to an exclusive membership club than a typical retail experience. Prospective buyers faced long waitlists, often without guarantees, and were subject to more extensive screening. The company also began shifting its messaging, highlighting craftsmanship, heritage, and long-term ownership, steering public perception away from short-term gains and toward intrinsic value. Beyond its distribution reforms, Rolex has also signaled an interest in increasing production volumes, albeit gradually and selectively. The aim is not to dilute the brand's aura of scarcity, but to ease the worst of the supply-demand imbalance that fueled the flipping frenzy. By slightly expanding availability, Rolex can reduce the price volatility of its most coveted models, thereby discouraging speculative buying behavior. At the same time, Rolex has invested in more bespoke customer experiences, exclusive collector events, and customization options designed to reward long-term loyalty and deepen brand engagement. This reorientation of strategy coincides with broader economic headwinds that are now dampening the appetite for speculative luxury purchases. Interest rates have climbed significantly since their pandemic-era lows, making borrowing more expensive and reducing overall liquidity in the market. Consumers who once viewed luxury watches as surefire investments are now approaching with greater caution. The secondary market, once characterized by skyrocketing prices and instant resale opportunities, has become more unpredictable. Several popular models that previously commanded premiums are now hovering near or even below retail, signaling a cooling of investor enthusiasm. One key driver behind this shift is the saturation of the market. As flipping became more mainstream, more participants entered the space, leading to intense competition and narrower profit margins. Arbitrage opportunities, once abundant due to geographic pricing discrepancies, have become harder to exploit, especially as Rolex enhances its global pricing alignment and tightens dealer policies. Watches that are once sold in one region for a modest markup are now far less lucrative to move across borders. Customs regulations, luxury import taxes, and stricter scrutiny from dealers have further curtailed the feasibility of this once popular tactic. At the same time, flippers are facing growing risks. Holding inventory for too long exposes sellers to price drops, and the overhead costs of marketing, shipping, and insurance cut into profits. Some gray market dealers are even beginning to offload inventory at a loss, simply to stay afloat. The days of instant returns with minimal effort are fading, replaced by a landscape that demands greater strategy, capital, and resilience. Interestingly, this shift may mark a return to balance in the luxury watch ecosystem. As opportunities exist in the market, genuine collectors are finding new opportunities to acquire models that were previously unobtainable. While the most hyped references still command attention, less speculative models are gaining appreciation for their design, craftsmanship, and historical significance. This redistribution of attention may help restore a healthier collector culture, one that values the art of horology as much as the financial upside. For authorized dealers, the changes bring a new set of challenges and opportunities. By prioritizing genuine clients and long-term relationships, they can build a more sustainable business model. At the same time, they must navigate growing expectations from Rolex headquarters, balance client demand, and manage relationships delicately in a market that remains emotionally charged and status-driven. From Rolex's perspective, these changes are not just about regaining control of the resale market, they're about protecting brand equity. A Rolex is meant to be a lifelong possession, an heirloom, a symbol of legacy. Allowing the brand to become synonymous with flipping threatened that narrative. By making it more difficult to treat Rolex watches as quick-turn commodities, the company is reaffirming its commitment to heritage, value, and long-term desirability. Looking forward, the luxury watch market is entering a new phase, one marked by uncertainty, recalibration, and opportunity. The flipping model, once regarded as an easy way to build wealth, is now fraught with risk. Those who continue to participate will need deeper market knowledge, more disciplined strategies, and a greater tolerance for volatility. For some, this may prompt a pivot toward other brands with growth potential or toward vintage and pre-owned segments where authenticity and rarity still command premiums. In conclusion, the Rolex flipping phenomenon is no longer the goldmine it once was. With tighter controls, shifting economics, and evolving consumer behavior, the easy money that once defined the secondary Rolex market is becoming a thing of the past. What lies ahead is a more discerning, selective, and complex environment, one where true enthusiasts, long-term collectors, and strategic players will set the tone. As the market matures, the Rolex brand appears to be reclaiming its intended position, not as a vessel for fast profits, but as a timeless expression of achievement, taste, and permanence. As the market evolves, authorized dealers will play an increasingly important role in shaping the future of Rolex sales. By prioritizing relationships with genuine customers and implementing measures to deter flipping, they can help to ensure that these iconic watches find their way onto the wrists of those who truly appreciate them. What are your thoughts on the topic we shared in this video? Let us know by leaving a comment and giving this video a thumbs up. Do not forget to subscribe to the Luxury World for more insights into the world of luxury timepieces.